We're going to start on Chapter 6 today. We're going to go over the PowerPoint. But one thing I wanted to draw your attention to is the something interesting. If you look at your book on page 267, once Sarbanes-Oxley was passed, approximately 1 in 8 companies had financial statement restatements. Some of relatively low amounts, others larger. So basically, if you restated, you must have had material weakness. We still have a hard time figuring out how so many companies that restated also could have reasonably concluded that their internal controls were effective and that they had no material weakness. The point being, after Sarbanes-Oxley came about, there were real strict guidelines as to responsibilities for material misstatements. And the fact that 1 in 8, which would be more like 13% of companies, went back and restated their financial statements really helped you see that all of a sudden the law that was enacted really put the screws to some of these companies and created a little panic in the public in order to get them to comply with guidelines. So what we're going to talk about in this chapter is really what it means to perform an integrated audit. Now, really, the key on this integrated audit that occurred after Sarbanes-Oxley is that we really need to take a look at internal controls and prepare an opinion based on internal controls. So we're going to talk about that. What I'd like to do is do a little bit of the PowerPoint and then go and let's look at some of the problems, just so as we're understanding the chapter, then we go and we put it to practice. The auditor's report on internal controls is really the key of what we're talking about in this chapter. One thing I do want to talk about is there are various types of opinions that an auditor can provide on the financial statements. The auditor, an ideal opinion on internal controls over financial reporting is an unqualified opinion, which means a clean opinion. Likewise, or on the contrary, a bad opinion would be considered an adverse opinion. So we're going to talk about specifically how an auditor needs to report on the opinion and what companies they're required to report on. You'll see here as you look on page 270 of your textbook, and it talks about a company's internal control over financial reporting is a process designed to provide reasonable assurance regarding the reliability of financial reporting and the preparation of financial statements for external purposes in accordance with generally accepted accounting principles. A company's internal control over financial reporting includes those policies and procedures that pertain to the maintenance of records that, in reasonable detail, accurately and fairly reflect the transactions and dispositions of the assets of the company, and then provide reasonable assurance that transactions are recorded as necessary to permit preparation of financial statements in accordance with generally accepted accounting principles, and that receipts and expenditures of the company are being made only in accordance with authorizations of management and directors of the company, and provide reasonable assurance regarding prevention or detection of unauthorized acquisition, use, or disposition of the company's assets that could have a material effect on the financial statements. Because of its inherent limitations, internal control over financial reporting may not prevent or detect misstatements. So basically what you're seeing here is the information regarding the need to report on internal controls. Here is a example for you of how that gets played into this picture. A couple other things I just wanted to look at. An adverse opinion on page 271, that's not good. An adverse report gets issued when the auditor finds one or more material weaknesses in the internal controls of a client. An example of an adverse report is shown on Exhibit 6-2. The auditor has to describe the weaknesses. It doesn't discuss the actions being taken. So basically, understanding the internal controls is part of this integrated audit we're going to talk about. Any questions before we start? You guys good? Okie doke. So we're going to start with Chapter 6. And as we've talked about in Chapter 5, things changed when Enron and WorldCom, along with all the other public companies, started having major fraud and companies going down the tubes. The Senate came in, or excuse me, the Congress came in and vastly changed some guidelines with the Sarbanes-Oxley Act, and it started requiring that public companies report on internal controls over financial reporting. And then in 2007, the PCAOB came up with the auditing standard that explained the details of an integrated audit and created standards that focused on how auditors need to look at internal controls and guidelines they created and set into place as to how auditors need to go about auditing and looking at those internal controls. So as a result of all this, we have something called an integrated audit. The auditing standards are in place for how auditors perform this integrated audit. As you can see here on this slide, this Standard 5 encourages management and auditors to implement a top-down, from the management on down, risk-based approach to identify significant accounts, relevant assertions along with those accounts, potential risk of misstatement, and controls that really need to be in place to avoid having risks on certain accounts. Also, another standard is it indicates a material weakness means that the control deficiency is such that there is a reasonable possibility that a material misstatement could occur, but might not be detected. So if a material misstatement could occur and not be detected, we've got problems with our financial statements, because part of our responsibility with these financial statements is to show that we've tested to make sure there are no material misstatements. Also, this standard recognizes that external auditors can rely on some of the company's evaluation or testing of controls. The internal audit function really is responsible for independently testing to make sure those internal controls are operating. We're supposed to, as auditors, document the process of looking at our risk and deficiencies, control deficiencies. And as a result of increasing audit efficiency, we're going to, if we can gain a greater reliance on these internal controls, then we can reduce other types of testing as part of the audit. So important to note, this integrated audit is really the baseline for how we're supposed to be conducting the audit as we look at internal controls for public companies. Okay, the audit report, we have to express an opinion on the internal controls. Requirement for the audit of internal controls is set out there in again, number 5. The auditor's objective in an audit of internal controls over financial reporting is to express an opinion on the effectiveness of the company's internal control over financial reporting. Because a company's internal control cannot be considered effective if there are one or more material weaknesses, to form a basis for expressing an opinion, the auditor needs to plan and perform the audit to obtain competent evidence that's sufficient. Don't you hate all these words? That competent evidence that's sufficient to obtain reasonable assurance about whether material weaknesses exist of the date specified in management's assessment. A material weakness in internal controls may exist even when financial statements are not materially misstated. How can that be, that there may be a material weakness in internal controls even though the financial statements are not materially misstated? Okay, even though there's a weakness in the controls, what did you just say? They might not be doing anything wrong. Exactly, Carmen. But the likelihood of there being a material misstatement in the financial statements is probably greater if there is a material deficiency in internal controls. Isn't that right? Make sense? So we are going to do a report to and do some testing to see how these internal controls are operating. Now, the auditor's report on internal controls gets integrated or put in, combined with the report on the company's financial statements. The internal control report is contained in the same report that contains an opinion on the financial statements. An accepted alternative is to issue 2 reports like the one we saw, one on the financial statements and the other on internal controls. However, if separate reports are issued, each report must refer to the other report. The auditor provides an opinion on the effectiveness of internal controls in the context of agreed upon criteria, that is the COSO internal control integrated framework. There are guidelines. You just can't create a letter expressing an opinion. There are specific guidelines that are in place we need to specifically state in issuing letters or opinions on financial statements and opinions on internal controls. Now, as you saw in the one that we read when we started the class here, the auditor recognizes and conveys to users that there are limitations of internal controls that can affect its effectiveness in the future. I believe if you look at this, let me see. If we go back to the book and we look at this one report, because of its inherent limitations, internal controls over financial reporting may not prevent or detect material misstatements. Also, projections of any evaluation of effectiveness to future periods are subject to the risk that controls may become inadequate because of changes in conditions, or that the degree of compliance with the policies or procedures may deteriorate. They're required to state that. Do you see how these reports are not just flippantly created? They're very intentional in their words. An adverse opinion. This is what you don't have to want to give. An adverse report on internal controls is issued when the auditor finds one or more material weaknesses in the client's internal control over financial reporting. The auditor describes the weakness identified in the management's report but doesn't discuss the actions being taken to overcome the problems. And it doesn't discuss whether the control weakness was first identified by management or by the auditor. But you're going to issue an adverse opinion if there's one or more material weaknesses on internal controls. So now we're going to start talking about this integrated audit. So public companies have to report on internal controls. And here is basically the guideline, the steps that we're going to take to look and to perform an integrated audit. We've spent a lot of these chapters talking about the control environment that's in place. Now we're specifically really interested in control environment over the financial transactions. So there's a control environment as far as protecting the inputs that get put into the system, the process in the accounting system, and then ultimately the financial statements, the results of all these processes. So we're going to look at this in control environment. We know the process is based on inputs. They go through the processes and come out with financial statements. And we're going to test the processes and controls to make sure they're working and in place. Now, when we do an audit, we are going to initially test these processes and controls, and based on what we come up with here, we're going to then create additional tests called substantive testing. They're much more detailed tests on the account balances. Okay? So as we continue to talk about an integrated audit, the key pieces we need to look at, the quality of internal controls, how that ultimately is going to affect our financial statements and the data of our financial statements. If we can trust the internal controls and if they're really operating effectively, then we're going to be able to trust those processes and ultimately the information that's getting processed through the system. The control environment is pervasive. It affects all aspects, and it affects the process of recording transactions. It affects the estimates we create and the adjusting journal entries we create. If the control environment is strong and the controls over transaction processing, adjusting, and the estimates we do are good, reliable, then both management and the auditors are going to have a high degree of confidence that the financial accounts are fairly stated and that the financial disclosures are adequate. So basically what that means is if we go and we really look at these internal controls and can tell they're really strong, they're operating, they're effective, it gives us a greater success rate in trusting that the financial statements are going to be fairly accurate because there are controls in place to protect the processes of financial reporting. Any questions on what I'm saying? Is this logical to you guys? Yes? So as we move on, a potential for misstatements exists in inputting, processing, estimate, or adjusting account balances. There's always a need to perform some substantive tests of material account balances, but the nature, timing, and extent of those tests will be dependent upon the quality of internal controls. Think of it this way. Even though you know the process is in place, that the all the paperwork is lined up, that you've received the appropriate approvals to pay a bill, what's the likelihood, instead of saying $73 or $37.22, what's the likelihood of someone who's keying that in instead of 37, say $73.22? Can it happen? All the time. Does that mean the person who then signs off on the check isn't going to necessarily see it? I mean, guys, stuff happens, doesn't it? Controls can really be in place well, but you're going to still have misstatements. But what a material misstatement might be is, let's say the bill is for $733, and someone writes the check on accident for $77,333. That could be material. It could still happen, couldn't it? Even though you have all the signatures in place, although you have all the checks, stuff happens. It's just part of being human. So internal controls are going to definitely reduce that chance, but it still isn't to say that those things can't happen. Any questions on that? The auditor's evidence is going to be based on testing internal controls, testing transactions, doing some substantive testing on account balances, and doing some analytical procedures. So we're going to do all kinds of testing, but we're going to gain an overall understanding initially on internal controls to then decide how we need to further develop our testing, our audit. So what are we going to do to start out this integrated audit? We're going to continually update the work papers on various risks that may be in place. We're going to look at where we could have some misstatements in the accounts. We'll do some preliminary analytical procedures like what you guys did with Built Right. Understand the internal controls. Then we're going to determine which controls we're going to test. We're going to make a plan to test those controls, then look at the results, and from that, create some substantive audit tests. So here's the process in place for doing an audit. Looks easy, doesn't it? Step 1, update information about various risks. This requires auditors to identify account balances and disclosures that might be materially misstated, why there might be misstatements, and then the processes that may affect one or more account balances. So we're going to start with this step 1. We're going to look at those accounts that could be susceptible to being misstated and why, and what other accounts could be affected as a result of it. So, let me go back here, and then we'll go step 2, step 3, step 4. However, with the PCAOB, they've provided some controls that we need to be aware of. We need to look at unusual transactions that are significant. Why does the PCAOB want us to really take a look at significant, unusual transactions? Could that be potentially where there might be a misstatement? You know, in the general course of a business, you're going to have the same type of transactions over and over again. The PCAOB is saying to us, hey, you really need to take a moment and really hone in on those unusual transactions, especially those that are late in the season, okay? Are journal entries that are just very unusual. Then they also tell us controls over journal entries and adjustments made in the period in financial reporting process. Who gets to create these journal entries? Are there controls in place as to who signs off on them? It's important that these journal entries, because that's not the normal process in the accounting department. So why are they being created? Who's authorized them? And what's this about? Related party transactions. We know in dealing with companies that the likelihood of related party transactions, that they're not an arm's length transaction, can be greater. So we want to be aware of any types of potential misstatements as it relates, and to look at those related party transactions. Controls related to significant management estimates. What do you think we're talking about here as far as management estimates? Anyone have a clue? What about allowance for doubtful accounts? What's the likelihood that management wants to make it look better than it really is, right? How about assets? Is it common that management would want the assets to look like they're going to be around longer than what's maybe potentially in place? It's going to allow their assets to be overstated or their depreciation to be understated. Controls that mitigate incentives for and pressures on management to falsify or inappropriately manage financial results. As we've talked about in this class, so many incentives of management and sales individuals have to do with their earnings. And so because that is a potential conflict, I mean, of course, we all want a company to do well, to perform well. But when your bonuses are directly tied with the profits of a company, can you see how that could potentially involve conflict? Now, step 2 talks about consider the possibility of account misstatements. We started this class talking about various types of risks, and one was a business risk. Business risk is where, just based on the environment that this business is conducting and the product or the service, there are potential changes in the market. There may be regulatory risks. And then there could be changes in the values of the assets or the values of the liabilities. Then we've got management's potential coercion of how they are compensated, the reward system, and how this ultimately affects the stock market, and what actions they may try to take short term to manipulate the market. So we're not necessarily worried about things if, let's say, they've got a stock option that really can't even be exercised for 5 years down the road. We're not so worried about this year. We might be worried about it in 5 years, though. And then processes affecting material account balances. High volumes of material transactions are something we're going to want to look at. IT risks and vulnerabilities. And then those processing of estimates or adjusting entries that are out of the norm. We're just going to want to take a look at those things that could be manipulated. Does that make sense? We're going to take a look at those items that could be easily manipulated. So then we want to understand the internal controls that are in place. We're going to document significant accounts, processes that are related to those accounts and controls, and then we're going to take a look at the control environment, risk assessment. We're going to monitor these. We're going to look at how management, through possibly internal auditors, test those controls, and if there are deficiencies, how management's corrected them, and then evaluating various controls that management has in place. From there, we're going to decide which of these controls we want to test. Now, why are we going to take the time to test these controls? If we test them and we find out that they're operating effectively, we can reduce other testing down the road. When we go to do really detailed testing of substantive testing, we'll be able to reduce them if we can really trust these controls. And then, ultimately, we're going to have to look at the internal auditing auditors to see, what kind of work do these internal auditors perform? Who do they report to? Can we rely on some of the work that they perform? Are they competent? What is their education? What is their skill level? How do they document everything they've done? It'd be great to be able to count on the internal auditing reports, because that would sure be able to limit some of our testing. But ultimately, guys, we're the ones responsible for creating this report. If there's any reason we shouldn't be able to trust the internal auditors. We better not, because we're ultimately responsible. We can't go back and say, oh, but we trusted the internal auditors and they were wrong. Then after we've gone through all these steps, we're going to make a plan to test the controls, and we're going to maybe have computerized controls, manual controls, and we're going to look at those. We're going to look at adjusting entries and accounting estimates to just see how they're operating. Now, this is a key. This is where we're going to start talking about assertions. We've been talking about this word assertions. You know, that the financial statements are correct, and that they are in sync with management's assertions. Well, what the heck does that mean? This is important. One assertion is called occurrence. Did something really happen? Did it occur? Are the recorded items really true? An example is, we might show that we have sales that really aren't sales, okay? So the way we test to make sure that all of these transactions really occurred is we can look at shipments that are recorded, are reconciled with shipping documents on a daily basis. Items cannot be recorded without establishing existence and validity of underlying source documents. So did something really occur? Did it really happen? We get to look at documents because if the shipment really occurred, that we sent out, we can bill the clients because we show a sale actually occurred. We would have to have paperwork that showed it existed and it's valid, correct? Another one, is it complete? Are all items recorded? Occurrences, are all items that are recorded really valid? Are they really true sales or shipments? Completeness means, are all valid items really recorded? Did we maybe leave out something? How do we know we have all expenses in there? Okay? Did we really record all valid transactions? How do we know about this? A lot of companies use pre-numbered documents. These pre-numbered shipping documents are a great tool in place because you need to count to make sure everyone's accounted for. If there's one that was voided, it should still be in place but show a void on it. What does that allow us to know? That everything's been accounted for. So do you understand the difference between occurrence? We're showing all items that are recorded, but are they valid? Completeness is all valid transactions, are they really recorded? So a way to know that things are complete, even like deposits, if you have pre-numbered deposit slips, you make sure you have them all in place. Pre-numbered shipping documents know that we've accounted for everything that's been shipped. Cash receipts, cash deposits. So that's a great way to know that everything that is valid is in fact in the books. Well, now there's something called valuation. So an assertion, are we valuing these items as they should be? Is it the correct valuation? Well, how do we determine that? A lot of times in the system, there are going to be pre-authorized sales prices. And let's say a customer has a certain volume that they purchase in a yearly to annual time. They might be given better discounts than a customer that only purchases $5,000 in a year. The customer that purchases $100,000 a year might be given a better discount. A lot of times those discounts, for those of you that are familiar with Peachtree, those sales prices get automatically input into the systems. Do you know what I'm talking about? So they cannot be overridden. Why do we care about that? Well, couldn't someone go in and somehow make it look as though the sales were 10,000 greater by just changing the item sales? But can you do that if all this is set in the system? It would take someone with IT controls or security controls to be able to override those guidelines. So valuing, are our sales really at 5,000 or are they at 4,000? Are we valuing the sales correctly? Potential outcomes with what we're doing here. If we notice that there are some deficiencies, then we need to look at these deficiencies and determine whether they're significant or are they material weaknesses. Or we need to look to see if the preliminary control risk assessment that we initially set up might need to be modified. Or we might need to look at these deficiencies and determine, do we need to revise control risk? And maybe we need to change some type of substantive testing, and because we might think there could be some more material misstatements. We're doing all this with the mindset that we can always go back and revise our plan. Okay? We want to look at these internal controls. If we can't trust the internal controls, we need to reevaluate how we're going to conduct the audit. Does that make sense? It's a constant revision. How are you guys doing so far? But let's say we go through all this internal control testing and everything looks pretty good. There aren't any deficiencies. Then we're going to look to see, is our control risk assessment that we had in place still right on? And then we might look to see how these controls can provide some type of evidence for us on, are the account balances right? And then from there we might look at doing some substantive testing, and maybe we can reduce our substantive testing because our controls are in place as we had hoped they would be. So there's a constant, from the information we gain, there's a constant revision of the potential audit tests that are in place. Now, as an auditor, we're going to have to come to terms with some questions here. How much assurance can be obtained regarding audit risk when internal controls are present and working? So, what is audit risk, guys? The risk that we issue an opinion, but the opinion's wrong. So, how much assurance can be obtained regarding audit risk when internal controls are present and working? If control activities within major processes are working properly throughout the year, what is the residual risk that remains that an account balance could still be misstated? What's the risk that the auditor's evaluation of internal controls might be incorrect? Which account balances contain more than an acceptable amount of risk that a material misstatement could occur? How would a misstatement in a material account balance most likely occur? And what are the most effective substantive tests of account balances to determine whether there's a misstatement in the account balance? Do you see, if it's our first year in doing a client, we're going to tend to be very, very cautious. Once we've been with the client for a period of time, the chances of being able to reduce these risks are going to be much greater. Does that make sense? Because we have some experience, some history with them, we're understanding the accounts, the transactions. So what's going to happen here? Factors affecting the extent of direct testing to be performed. If we talk about audit risk, and the assessment is low, that even though we've performed the audit, the chances of us still issuing the wrong statement, the wrong opinion, is there. If the auditor assesses that audit risk is low, then we might do more direct testing. If the business risk is high, we may do more direct testing. If we're not sure of the accounting processes, and it's kind of a gray issue, we're going to want to do more direct testing. If we're concerned about materiality in account balances, we're going to do more direct testing. The effectiveness of internal controls as assessed by management and the auditor. If we can really trust these internal controls in place, we might reduce our direct testing, won't we? And then if we are gaining some security based on testing other accounts as they relate to the accounts in question, directional tests indicate low risk of misstatement, we might be able to reduce our direct testing. So as a result of certain factors, what are the results of the audit? Either more direct testing or less. So for example, misstatements and how we're going to look at these. If there are some unusual sales items, wouldn't we want to get a listing of all those sales items and really target those large sales items, especially the ones in the last quarter? Another question we might look at is, how much could revenue and accounts receivable be off if all of these unusual sales items are incorrect? So we might look at a dollar amount determining, okay, if all these unusual sales items are truly all wrong, how much can sales be off? And then an auditor needs to go through the sales and the receivables, and they've got to see, hey, have they been recorded properly? How are we going to look at those? We might just gain a sample of some of them, have them looked at. So there's different things we're going to do as an auditor to gain an understanding of what potential misstatements could be there and how we're going to look to find them. I think what I'd like to do now is take a little break. Let's go and do a problem at the back of the chapter. How you guys doing? Does that sound okay? Okay, let's look on the multiple choice on page 293. Let's just take some of these and look through them. Okay, we'll start with 624. The auditor wants to develop a top-down risk-based approach to perform an integrated audit of internal controls and financial statements for a public company. Which of the following statements is correct regarding the integrated audit? So here's some choices. The auditor should start with the errors detected in last year's audit. Did we hear anything about that? The auditor should start by identifying material account balance disclosures and relevant assertions and assess the risk that those account balances could be misstated? How come, guys? That's exactly right. That's where we're going to begin. Identifying those account balances, the disclosures, those relevant assertions, we're talking about valuation completeness, and being able to assess the risks that those balances could be misstated. Good job. Let's do 625 now. The auditor discovers that there is a key control failure over sales contracts, and that some contracts near the end of the year are not properly reviewed by management. Which of the following would be the best way for the auditor to respond to the control deficiency identified? Would we A, expand the testing over the control with a larger sample from the last quarter of the year? We already know that there's a key failure, don't we? Would we wait to assess whether the deficiency is a material weakness or significant deficiency based on the actual number of errors or misstatements found in the related account balance size? Or would we expand the sample size for substantive testing and review of contracts during the latter part of the year to determine if revenue is appropriately identified? Yes. We're going to do that. We're going to just expand this sample size, review the contracts, especially over the last part of the year. Why? Because the potential for misstatements at the end of the year to show there were actual sales is going to be greater. Okay, 626. Which of the following statements is correct regarding the auditor's report on a public company's internal controls over financial reporting? A company cannot have a material weakness in internal controls if the auditor does a generally accepted auditing standards audit and does not find a material misstatement. The auditor must explicitly reference the criteria for evaluating internal controls in the COSO framework. That's correct. The other two would be the audits performed in conjunction with the auditing standards, or the audit must report on whether management used appropriate tools. It is B. Let's do one more and then we'll call it a day till tomorrow. The auditor is auditing sales and accounts receivable and notes the following. The company regularly does not follow its credit policies. Rather, it routinely overrides the credit policy when divisional management needs to meet its performance goals. And the sales manager has the ability to override the credit policy for important customers. This isn't looking good, guys. However, the controls over proper recording of sales transactions are working. Which of the following statements would be correct regarding an integrated audit of sales and receivables? So we've got three pieces here. The most relevant assertion regarding receivables to test for this client is the existence assertion. Is the amount of credit overridden? If the amount of credit overridden is such that the likely uncollectible amount is material, the auditor should conclude that the client has a material weakness in internal controls. The monitoring aspect of internal controls is not working effectively. So do you think it's 1, 2, and 3? 2 and 3. Why is 1 not the issue? We're not worried about the existence assertion. We're assuming it exists, but we're worried about, is it really going to be collectible because of the way they're overriding guidelines? It's not following the credit policies, correct? Isn't that our concern here? Are we going to ultimately collect it? Guys, we'll pick up on this